Hello, hello. Welcome out to the Traders Market Intelligence Report. My name is Tony Benson. I am filling in for Rob as he is on vacation this week. So I will try to do what he does justice and see if I can reach his level. So anyway, I'm just going to have some fun and show you what I do and how I do it and make it brief. But first, I'm not a registered broker-dealer investment advisor. I'm not going to give you any recommendations or advice. Everything we do here is purely for educational purposes. If I do happen to mention a trade, just assume it is a paper trade or a practice trade. For regulatory reasons, we do not discuss funded trading. So here's all that's coming up. Trading You, February 10th, and Inner Circle, February 18th. Monster Market Movers, the 25th. Patterns in a Flash with yours truly, March 10th and 24th. That is 8 o'clock. And then Mastermind Group, Tuesdays at 8. The free online workshops, Power Hour, every Monday at noon. Key to Be Free, Wednesday the 17th. How to Trade the Market, Feb 17th and 24th. Two different times on those days. And then Power Option Plays, Tuesday and Saturday. Cover Call Explorer on Saturday. And E-mini Think Tank, Monday, Wednesday, and Thursday. Of course, you can find us on all the social media, as you probably all know, right? And that blank screen right there says to go over to the charts, because this is where I live. So this is what I love doing, technical analysis. I fell into it when I first started back in 2000, and I realized how powerful it was then, and have been doing it ever since. But there's the SPX, and not sure if you all saw it, but we had a nice, actually a very classic evening star pattern show up on Thursday. And then, of course, Friday, yesterday, we gapped up a little bit and sold off by the end of the day and closed basically even. I mean, it was up 1 point, which on a 4,500 point index is pretty much nothing. So we basically broke even from the day before. But if we look at long-term picture on the SPX, we are at a resistance point, right? This 45.50 area, 45.30, 45.50 range, right? Because support and resistance is a range. I'm trying to remember who said it. I think it was Steve Nissen. Maybe it was John Murphy. I don't know. Two technical analysis legends, right? You want to draw support and resistance and trend lines with a crayon and not a pencil, right? So it's more of a range than anything. And this is a weekly chart that we're looking at. So you're talking about entire weeks. But you can see that there's some significant points here. This is back in 21 when we hit a high. It broke above that. Then it came back and found that old high as support, which is typical role reversal. If you have gone through patterns in a flash, you know exactly what role reversal is. If you have not, I would suggest you jump on that, at least get the trial and check it out. There's a video in there about role reversal and why it happens and how significant it is. It is a major tool to use in technical analysis when it comes to picking points to trade from. So I use it daily. But the psychology behind it is, I think, what's important to understand. But you can see we got the same point we're at there, right? 45.30, 45.50, right in that area. Of course, it breaks it right after, and then when it comes back up, where does it hit it? It recognizes that spot again, and that's where it tanks from in 22. So we are at a point that if the market breaks through this and it continues higher, I would say we're going to go up and ring this bell, the all-time high, which is a little bit mind-boggling to me. Considering the macro data and the stuff that's going on behind the scenes that most people don't see. So from that perspective, I'm not surprised at all because a lot of people don't pay attention to the macro data, or if they do, they just stick their head in the sand and they don't see it all, or they prefer to see only the rose-colored stuff. So a lot of the underlying data of the overall economy and what's going on behind the scenes is not that great. There's some good stuff and some bad stuff, and there's some really ugly stuff that it could send us off the cliff any day. If one major event happens, then this market could turn over and just start tanking. I mean, there's the COVID crash, right? That was, 3 or 4 weeks worth, I think, if I remember right. Yeah, 1, 2, 3, 4 weeks. We went from 3,500 to 2,250, right? So it's not unusual to have something like that happen. You can see back here even, this is 17. This is 2 weeks to go from 2,800 to 25. I guess that's 300 points. That's only 12%, 10, 12%, something like that. But 10 or 12% in 2 weeks is a lot, right? And then you've got this one here, which is, I don't know, that's several weeks, but 29 to 600 points. So again, almost a 20% drop. So if we have, like I say, I mean, I don't expect another pandemic, a COVID type of thing. This was rather unusual, but at the same time, we could have a big enough event that it starts a downward move, and we have a longer move like this that's maybe 20%, which 20% would be 900 points, which puts us, at 3,400, which is basically right down here are the lows again. So it's entirely possible. So I'm not saying it's going to happen. I don't know. As traders, our job is not to know what's going to happen. It is to come up with probability of what might happen next and then get in the way of it, right? And if it doesn't work the way we thought it would and it doesn't go as expected or planned, then we get out of the way, right? So trading is about odds and probability, not knowing stuff. So, but it is obviously important to have an analysis, right? A big picture idea of what you think is happening overall. But then on a short-term basis, we're using the charts to enter and trade on a short-term basis. So there's the SPX. I will also, real quick, we're going to play with the Dow Jones. Here's the Dow. It finally broke out last week, which it's the only index that hadn't really broken out to new highs compared to the other four majors, right? I look at the SPX, the Russell, the Dow, and the NASDAQ. Those are the four that I watch on a regular basis. Right? I've added these three recently just for intermarket analysis. So we'll go through those real quickly too. But the Dow was just holding out. It wasn't breaking above that 34.3, 34.5 level. And it finally cracked it this last week. So, and everything else, I mean, the Russell has been, it's kind of stale. It's been sitting down here. And if you're not familiar with the Russell, this is the small cap companies. These are 2,000 of the small businesses, if you will, when it comes to publicly traded, right? They're not Microsoft or Google. They're little guys. This is where, and you can see the banking crash right here. This is where a lot of those regional banks reside. This is the index that they're part of because they're not Bank of America or JP Morgan, right? They're not huge. They're not in the Dow or the SPX. So that's one of the reasons the Russell got beat up so bad. And that's one of the reasons it hasn't really come back that much either. But it finally broke out. It still hasn't made a 52-week high. It's got that 2,000 mark to test first. So, and this is one of the things that I watched in 21, where the Russell was sideways, where the rest of the markets were still going north. And I was telling everybody in the Weekly Whispers and in Patterns of Flash, getting the pattern of the week, be careful, because this is a sign, in my opinion, that overall, the big picture, the Russell, right, because many of you have probably heard, right, the little companies, the small businesses are the ones who bring us out of a recession. When we're in a recession, everybody touts small businesses. Small business will bring us out of the recession. Well, the inverse of that is true as well. So if they're the little companies out on the rowboat, right, versus the Microsofts, the Googles, the Apples, the FANG stocks, right, they're out in a big old giant cruise ship in the ocean. If a relatively minor storm comes, it doesn't have much of an effect on them, right? But a little tiny fishing boat, they'll capsize. So they have to run for the hills, or they have to run for shore a lot faster. So the little guys are affected in a bearish economy, in a negative economy, faster than the big guys, right? They don't have as much cash on hand. They've got to make moves faster to protect themselves and preserve their cash. So the Russell can be, I'm not a fan of the term leading indicator, but it can be. In certain senses, I like the term, but at the same time, it's misused a lot. Let's put it that way. But I think the Russell can be a leading indicator, like the inverted yield curve, right? If you're familiar with that, then you know exactly what that means. The odds are that we're going into a recession at some point in the near future. The question becomes when. And there's a lot of data that points to that. The inverted yield curve is one of them. You look at GDI, which should be coinciding with GDP, right? I talked about GDI, I think it was, what was it, Trading Coach's Playbook? It's gross domestic income, right? You got gross domestic product, but gross domestic income should be in lockstep with that. And it's not. It's actually declining. So eventually GDP will most likely catch up with that, which means that if it does, unless GDI turns around and catches back up, which is not likely, but it is possible. So we shall see. It's just there's a lot of wishy-washy stuff. So if you're having if you're struggling with this market, you're not alone. Everybody is. Okay? Everybody is just kind of scratching their head going, I don't get it. It doesn't make sense. But the market doesn't make sense a lot of times, so it's not that abnormal. But the one thing that is interesting is that the NASDAQ is also kind of an evening star. It's not as nice as the SPX, but the NASDAQ has rallied back a bunch because they got beat up a bunch, right? They're tech stocks. They're very sensitive to interest rates and the economy. So We'll see what happens. At this moment, it still looks really bullish, but like I say, that could change anytime. Here's where it gets a little interesting. Look at the dollar. And the dollar got trashed over the last couple of weeks, which sent gold rising, right? Because they're pretty much inverse. They're a negative correlation. So when the dollar goes down, gold goes up, vice versa. So, excuse me, sorry. Stupid allergies. But yeah, historically, if the dollar goes back down to the 90 level, gold will probably run way past 2,000. But the weird part is, and I know I'm probably going a lot longer than I should, but what is that? GC 3-055. What is interesting is, well, this is not the best. I meant to put oil on there, actually. Is that lately, in fact, let's do that. Let me do a comparison of oil. Because typically the dollar and commodities are inverse, right? They're negative correlated, so they go opposite each other. But in the last year or two, they've actually traded together. See, this is a normal relationship back here, where the purple line is oil. Oil tanks, dollar goes higher, and vice versa, right? But then all of a sudden in 21 and 22, you've got gold or the dollar going higher and oil going higher. And they started to get back to a normal relationship here where the dollar continued higher and gold went down. But now, I mean, they're both kind of sideways. And it's finally, we're somewhat relatively normal now where the dollar has dropped off and oil has ticked up. But this inverted relationship or negative correlation, if you want to, whatever you want to call it, is normal. And we're not in a normal market. And you look at other commodities, same thing. They're normally the opposite. And they're trading together in tandem. So it's an unusual market. So there's the dollar and there's gold. Let me get back to there. So, which you can see is normal, right? Just looking at Friday, gold is down, the dollar was up. Oil was up as well, when typically oil and the dollar go opposites. But one day is not that big of a deal. In the big picture, they should go opposite each other. So, clear as mud. I'm going to show you two real things real quick from my Weekly Whispers a couple weeks ago. Just so you can see just a little preview as to what we do in the Weekly Whispers is essentially I go through my entire list. It's usually about 300 stocks. Look for particular patterns. And then narrow it down to the best of the best. And then create a trading plan on it. And then I do analysis. And I do a video that's usually about an hour long going through macro analysis, what I see in the big picture, looking at news that's coming up. Basically, it's an entire analysis for you to get a trading plan for the upcoming week. So, and there's a couple trades here. This is Duke Energy. This was a ascending triangle. This was a couple weeks ago. This was on the 13th when I did this. So, just want to show you, just so you, again, so you get an idea of what we look at in here. And some of them play out, some of them don't. So, Duke has played out. It rallied up and then it pulled back, but then it busted back north. And we're about halfway to the target right now. We had a nice little ascending triangle going on. And we were looking for it to break north, and it has, at this point, played out. It's playing out right now. So OVV is another one, inverted head and shoulders. There's the neckline. It broke out. I wasn't super excited about it, but it did kind of finally stabilize and hold this level. And it gave us a couple of different entry points here, and hasn't hit the stop yet, but we're about halfway to the target on that. So, and I'll show you one. I don't know if there's any that, here's one that went crazy. But I don't know what happened. I think that's earnings yesterday. So you can't really trade it with earnings. Some of these, like Bank of America, we had a different trading plan on. But you can't trade it 2 days before earnings. So, but that's what we do in the Weekly Whispers. I go and, again, find patterns. Usually have about 20 to 30 stocks every week where we have some kind of pattern. I put a plan on there. I give you the analysis, what I think, what I see. And then you take it from there. And if you jump on it, you jump on it. If you don't, then don't. I mean, I don't catch them all. There's too many. I mean, you can't do every single trade opportunity you find. I mean, you could, but you're going to have either a ton of cash laying around, but it will drive you crazy. I've had 15 and 20 trades on at a time, and it just fries your brain. It's too much. So usually 4 to 6 is where I like to stay. So out of the 20 or 30 that I get every week, usually only 1 or 2, maybe 5 or 6 will trigger. So not every single one of them actually go off. This is just a couple that actually triggered this last week. So, and I don't know that any other ones did. So, all right. That's it for the Traders Market Intelligence Report this week. Hopefully you have all got a little nugget here or there. And we will see you either in Patterns of Flash, Weekly Whispers, or at the next event. Y'all take care. Have a great weekend. God bless. Bye-bye.